Yes, this is a shirt with lobsters on it. What's going on, everyone? Got a really fun one for you guys today. A lot of people have been reaching out to me. They're going, Steven, what's going on with this whole Bitcoin futures stuff? What are futures contracts? How can I get involved with Bitcoin via the futures market? Well, before we get into that, I want to talk to you about what the futures market actually is, why it was created, what it was created for, and what it's used now. Knowing that will allow you to put into context once we get into exactly what Bitcoin futures are and how you go about trading them. So this will be a fun one today. The futures market has been along for a long time, almost 200 years, and what it was created for is a lot different than it is today. If you guys remember, the stock market was created so that individuals like you and I would be able to fund public companies and get in return equity in the company, right? That has obviously changed a lot a bit. Capitalism has taken over, and now the stock market is just a way for people to make money if they can. The futures market, not much different. The futures market had a real strong purpose when it was created. Now it's a little bit different. So let's click some buttons here. Let's get inside the computer, and I'll tell you about why the futures market was created, what it was created for, and what has come of it now. Okay, boys and girls, ladies and gentlemen, children of all ages, we are back inside the computer, and we're talking today about the futures market. Again, a lot of people have been reaching out to me. They say, hey, Steven, in the last few weeks, we've heard, we've noticed that Bitcoin futures are now able to trade. What is a futures contract? How do we get involved? How do we make money from this thing? Everyone sees other people and hearing about other people making money via Bitcoin, and now that there's futures contracts, can I jump in? Well, before we get into that, I want to educate you guys on what futures are, what the futures market was created for, and what it is now, because it's a lot different than the equity market. If we look at the equity market, that's stocks like Amazon, Netflix, Google, Apple, Zillow, all those different companies that you can buy or sell. The futures market and futures contracts are a lot different. They're a lot different. The stock market was created way back when with the purpose of allowing individuals to fund publicly traded companies in exchange for equity and voting shares in that company. Now, obviously, it's a lot different now. Now, capitalism, as I mentioned before, has completely taken over, and the stock market now is just a way to facilitate transactions, and not only that, but a way for people to try to make as much money as possible. The futures market, again, had a much different purpose back when it was created, and there's a much different purpose from what it was created to what it is now. So it's completely different. So in this video, we're going to go into what futures are, what the futures market was created for, and what it has become now. So this would be kind of a fun and educational piece. So futures, right? So in 1848, the SIBO, the Chicago Board of Trade, was created, and the first futures contract that was available to be traded was corn futures. That's right, corn futures. And futures are contracts or agreements that, like options, are agreements to buy or sell a certain amount of the underlying asset. Right? So in options, they're agreements to buy or sell 100 shares of stock for every one option that we hold. Futures, on the other hand, at least speaking about commodities, are agreements to buy or sell a certain amount of the underlying assets. So when we talk about corn futures being the first type of futures contract that was available on the Chicago Board of Trade, the underlying asset was literally corn, right? At an agreed upon price, at an agreed upon date, right? So whereas options, agreed upon date is when a contract expires. With future, the agreed upon date is the delivery date. Let's kind of go into the platform and see what we're talking about here. So if we go into a company or a stock like Apple, okay? With Apple, as we know, if you guys have looked at any of our other, let me just make this a little better. Apple, as you guys know, if you watched our other videos, in terms of options, Apple options expire to stock. Now, how do I know Apple options expire to stock? I know Apple options expire to stock because there's volume, which means there's stock to trade. All options where there is stock to trade, they settle to stock. Now, we had another video, which I'll link in the description, where we have some of these indexes, some of these quote-unquote stocks, where there is no volume. In that case, those options settle to cash. But if you go back to the Apple example, remember, options have this agreed upon date where this facilitating, where this exchange of stock happens, right? That is when it expires. That is when it expires. But as we mentioned with futures contracts, and specifically agricultural futures contracts, there is an agreed upon delivery date. So let me see here. We're going right now to corn futures. So right now with corn futures, we have options, and those options, those settle to futures contracts. But at the same time, we also have futures contracts that have different expiration cycles. So this is where it gets a little bit different. In stock will always be available to trade as long as the company is solvent or is still public. Futures, on the other hand, are contracts that expire at different dates. And those different dates, when they expire, are the delivery date. So this is where it becomes a little fun as well as a little bit different. And this is kind of where it's kind of cool to me. This is where I really find futures contracts really interesting. So before we get into that, why were futures created? Well, futures were created, and this is really cool. Futures were created as a way for agriculture buyers and sellers to lock in sale or purchase prices at the current market value for crop delivered in the future. This is really interesting. So futures have many contracts which can be traded months in advance of the actual delivery date. Right? A producer can lock in a sale price for his or her crop today for a crop that is not due until months in the future. So this is where it gets really, really interesting. And let's take a look at these corn futures. Let's look at an expiration like this one right here, ZCU8. ZCU8 expires 254 days in the future. That's the September expiration, right? 254 days in the future. That's a September expiration. So the reason futures contracts were created is something like this. Let's say I am a producer, a farmer of corn, and my crop is not going to be available to deliver to buyers until September, 254 days from now. So the futures contracts and the futures market was created so that I myself, as a producer, as a farmer of corn, can lock in my profits for my crop that is not going to be available for 254 days from now. So right now, the current price for one futures contract, and we'll get into exactly what all these futures contracts are worth, but I can now say, okay, I have X amount of corn. That equals one futures contract. That corn is not going to be ready to be sold until the middle of September, 254 days from now. But if I think for whatever reason that the value of that corn is going to go down over time, I can sell a futures contract at the current market value, for that contract when my crop is going to be ready. And that's really, really interesting. On the other hand, what could happen is if I have crop that, again, is not going to expire until 254 days from now, and I think the value of one of those contracts right now is $371.50 per contract is low, I don't have to worry about selling my crop right now in the futures market to lock in a price because I can let it run. So that's really why it was created, and that's why it's kind of cool. That's why I think it's really, really cool. Let's take it a step further. So what was next? Well, that was an awesome example. As an agricultural producer, buyer, and seller, we were able to lock in either a profit at prices for right now with the idea that we thought the value of our crop was going to go down over time, or if we thought the value of our crop was going to go up over time, we would not have to worry about locking in our profits now because, again, there's a fair market for a crop that is not going to be available for delivery until much later on in the future. So what happened was, after these futures contracts for agricultural products went so well, there was such demand for futures contracts for other financial products such as currency and equity indexes. Right? So the concept of locking in a sale or purchase price for something that does not have to be delivered for many months is an excellent idea, as it works for both buyers and sellers. So if we're thinking about something like currency, let's say US dollars, a seller of US dollars many, many, many months in the future does not have to deliver those dollars until many months in the future. So they're speculating on what price is going to happen. They might think that the value of those dollars that is due for them to sell much, much further out in the future might be worth less when it comes time to sell. So they're locking in their profits at a current point. So that's why it's super, super interesting. But while that sounds awesome, was it too good to be true? And this is kind of where we get into the whole idea where, hey, the stock market was created so individuals like you and I could fund and have equity in voting shares in publicly traded companies and allow them to be more capitalized so they could do more good with their money, right? Futures markets, I get the idea of locking in profits for something that isn't due months in the future, but this is where it kind of took a little bit of a turn. It turned out that because these products were not to be delivered until sometime in the future, not 100 cents on the dollar was required to complete the agreement or transaction. So if we go back to our example of corn, let's say we have whatever amount of corn, which actually is 500 bushels, 5,000 bushels. So let's say we had 5,000 bushels of corn, and that's all our crop was. And again, we thought that that they were going to be ready to deliver 254 days from now. And the price per bushel, 370, 150, we thought was really high. And we thought over that 254 days before our 5,000 bushels of corn are ready to actually be delivered, we thought the value of that corn was going to go down. We can go ahead and sell that contract. That's a phenomenal thing for agricultural producers, for currency exchangers. That's a phenomenal, phenomenal thing. But we don't have to have that crop ready for 254 days. The delivery date is so far out that we don't have to have any of that crop ready, actually. If we could produce 5,000 bushels of corn in the next 254 days, well, hell, we're locking in profits for something we haven't even made yet. Now, this is where it gets really, really interesting, right? So because of that, I don't have any of this corn. Why should I have to put up 100 cents on the dollar for the value of that contract when I don't even have the thing ready? I mean, I need money to be able to produce this crop to make sure that it's ready to go 254 days from now. So because of that, futures contracts do not require 100 cents on the dollar to complete the agreement or transaction or contract. So for example, one futures contract of corn is currently worth 5,000 bushels of corn, or $17,450, right? So if I have right now 5,000 bushels of corn, that's worth about $17,500. However, if I'm a producer and I go ahead and sell one contract because I want to lock in my profit for that 5,000 bushel of corn, if I want to lock in my sale price, the margin requirement is just 4% of that, or $715. So let's look at that in the whole thing. I have 5,000 bushels of corn. That right now is worth $17,450. If I think the value of that corn is going to go down before my corn is ready to be delivered 254 days from now, I can go ahead and sell one futures contract in the expiration that is synced with my delivery date. And I can lock in a sale price now with the idea that I firmly believe the value of that bushel, those 5,000 bushels of corn, is going to go down. So I'll be locking in a price higher than I think is actually going to happen. But again, I don't have any of that corn. Or it's in the ground, or it's winter. And I need a lot more money to be able to make sure and guarantee that that 5,000 bushels of corn is going to be ready to deliver come the time that it expires. So because of that, there's no way I could put up all the money. There's no way I could do that. So I only have to put up a fraction of that, or just 4%. Now, guys, if you remember, the stock market was created for a way for people in the public, you and I, to be able to fund publicly traded companies, to give them more capital so they can go out there, do research and development, buy more companies, hire better talent. In exchange, we would get voting shares and equity in the company. Remember, futures contracts were created so that agricultural producers, buyers, and sellers could be able to lock in certain prices for either buying agriculture or selling agriculture many, many months in advance. But with that came crazy amounts of leverage, as you can see. To yield one corn futures contract, which is the equivalent to 5,000 bushels of corn, we only need 4% of the total value of that contract. So as you guys can see, everyone started taking advantage of this in a big, big way. The speculators, the big money players, right? You can actually wield and yield big amounts of money for only fractions of the cost in the futures market. So how much leverage? Well, for agricultural products, soybeans, you get 27-to-1 leverage. For wheat, we get 20-to-1 leverage. For corn, we get 24-to-1 leverage. So for something like soybeans, if you want to speculate on the price of soybeans, you only have to put up $1 for every $27 of value you actually wield. It's really, really cool. How much leverage for energy products? Well, if you want to have $56,000 plus of crude oil, which is the value of one crude oil contract, you can only put up $2,300 of margin. So for every $1 in crude oil you put up, you get $25 to play with. The symbol for crude oil is /CL, and as you can see, there are many expirations for these contracts where a certain amount of barrels, if this ever loads, where a certain amount of barrels of oil are due. Really, really cool. So there are a certain amount of barrels. If we trade this contract, there are a certain amount of barrels of crude oil that are due on the delivery date for this contract, which is in 122 days. So again, if we're a producer of crude oil and we think the value of crude oil is going to go down over the next 122 days, we can go ahead and sell one futures contract and lock in our sale price many, many months in the future and then deliver that crude oil in 122 days. So there's crazy leverage with it. Metals, things like gold, silver, and copper. As you can see, 26-to-1 leverage for gold, 14-to-1 leverage for silver, 25-to-1 leverage for copper. So in gold futures, we have a contract that has a notional value right now of over $125,000, and we don't even have to put up $5,000 of margin in order to have that contract. It's crazy. What about FX products? Well, the euro, which has insane leverage, 64-to-1. So to yield a contract, to wield it, to sling it around, the contract that has a value of $150,000, we only have to put up $2,300. That's 64-to-1 leverage. So the contract, 6E is the symbol for the euro futures, and it's absolutely insane. So again, guys, you get, let me see here on my notes. You get 64-to-1 leverage when you're talking about having one futures contract for crude oil. Absolutely amazing. Absolutely amazing. What's next? Equity index products like the S&P 500, like the NASDAQ, like the Dow. Again, you get to have crazy amounts of notional value, crazy amounts of leverage for only a fraction of the price. So if you want to trade the S&P futures, /ES, this is the most popular futures product in the entire world, the S&P futures contracts. You get $133,000 worth of notional value, and you only have to put up $5,000 worth of margin to be able to sling this around. That's 27-to-1. Amazing. So clearly, guys, the futures market was hijacked. But can you really blame these guys? You know, with this much leverage, speculators could not resist getting involved and turning a market that was created to mitigate risk for a producer or purchaser of agriculture, right, has now been completely overtaken by speculators, banks, institutions, and high-frequency traders because they cannot help themselves. They cannot help themselves at all. Again, huge leverage. 27 to 1 on equity index products. 64 to 1 on FX products. 26 to 1 on things like gold. 25 to 1 on things like crude oil. 27 to 1 on things like soybeans. 24 to 1 on things like corn futures. So how can you blame these guys for taking the futures market that was meant for a completely different purpose and has turned it into a entirely speculating market? Speculators are 99.99% of the entire market. And those speculators do include banks, institutions, high frequency traders, right? Individual retail traders are such a small part of the entire futures market. Again, guys, it's completely different because if there's a way to make money, well, damn it, everyone will chase it. Even if it's a really small hole, there will be a huge fight to go ahead and chase that hole because there's money to be made. And what's even better about futures is the leverage is crazy. The leverage is absolutely crazy. You cannot get this type of leverage trading equities. So as you can see, guys, the futures market was created for one thing at the beginning, right? To facilitate the buying and selling of agricultural products, services very far in the future. So again, if I was a producer of corn, I can go ahead and lock in a sale price for my crop. Remember, one corn futures contract is equivalent to 5,000 bushels of corn. I don't even know what that is. But if I thought the price of the value of my corn, of my crop, was going to go down until it was ready to be delivered, I can go ahead and lock in a sale price now. That's why it was created, and that's a phenomenal reason why it was created. But again, I might not have all of that corn already ready, my crop already ready. I might have to take some money and I might have to invest it to guarantee that that corn is going to be ready to be delivered on delivery date. So I don't want to have to put up all that money in order to facilitate that sale because, hell, I need that money to go ahead and make sure that corn is ready to go. So because of that, there's crazy amounts of leverage. There's crazy amounts of leverage within the futures market because of that. And then they took it out of agriculture. They put it into precious metals, equity indexes, foreign exchange, anything you can think of, energy products, anything you could think of. Now, because there is so much leverage, the futures market should only be traded by the most professional type of traders. The most professional type of traders. With something like the S&P futures, although it is the most popular product in the world, you get to yield right now, as the price stands today, about $133,000 worth of notional value and only put it about $5,000. But the reality is, you could lose $5,000 in a matter of a few days because the notional value is so big and the leverage is so high. Again, if you are not a big-time professional investor, you should not even be thinking about futures. I get it. You want to make a lot of money. You see online, people are making all this money. With cryptocurrencies, all of a sudden, people are like doubling their money overnight. With some of these stocks that are related to cryptocurrencies, people are making so much money. You've watched a lot of YouTube videos about people doubling their money in a month. That is not realistic. Trading in the futures, I get it. You get so much leverage. You totally feel like, hey, if I just had one big one, I would make so much money. I wouldn't have to make any trades for the rest of the year. I get it. I've been there. I got my butt handed to me in the futures market. But again, guys, unless you are a big-time professional investor, if you've been doing this for years and years and years, don't even think about the futures market. Don't even consider it. Don't even look at the thing. Seriously, stay away from futures unless you're a big-time trader. But I hope this was helpful in terms of just educating you guys. If you're going to get into futures, if you have been doing it for a long time, it was best you actually understood what they actually were, why they were created, and what they're actually used for right now. So I hope this was fun. It was fun for me. I hope it was educational, and I'll see you guys in the next video.